How has inflation targeting shaped monetary policy historically? Imagine a world where central banks have a clear goal for prices and stick to it. That's what inflation targeting brought to the world of money and economics. It all started in the early 1990s when countries wanted a better way to keep inflation stable. Before that, many central banks often made decisions based on guesses or political pressures, which sometimes led to high or unpredictable inflation. Countries like New Zealand led the way in 1990 by setting a specific inflation goal, usually around 2%. This meant they aimed to keep prices rising at a steady, predictable pace. Other countries like Canada and the United Kingdom followed soon after. Inflation targeting became popular because it gave central banks a clear target to aim for. They would announce their inflation goal openly, which helped people understand what to expect from monetary policy. Central banks would then adjust short-term interest rates to keep inflation close to that target. If inflation looked like it was rising too fast, they would raise interest rates to slow down spending and price increases. If inflation was too low, they would lower interest rates to encourage more spending and investment. This approach made monetary policy more transparent and predictable, which helped build trust with the public and markets. This new way of managing money also changed how central banks responded to economic shocks. During the financial crisis of 2008 and the COVID-19 pandemic, central banks focused on keeping inflation stable while supporting the economy. They used interest rate cuts and unconventional tools like buying bonds to help recovery. But inflation targeting also has its challenges. For example, supply shocks like rising oil prices can push inflation higher without boosting demand, making it harder to keep inflation on target. Also, balancing inflation control with financial stability can be tricky at times. In the United States, the Federal Reserve adopted a formal 2% inflation goal in 2012. Before that, they had a more informal target, usually around 1.5%. This change was partly because low inflation limits the effectiveness of cutting interest rates during recessions. By setting a clear goal, the Federal Reserve aimed to better manage expectations and improve economic stability. Overall, inflation targeting has shaped how central banks run monetary policy. It gave them a clear goal, made their actions more transparent, and helped anchor inflation expectations. While it's not perfect and faces some hurdles, it remains a key part of how economies are managed today. This approach has influenced many countries and continues to guide central banks in their efforts to keep prices stable and support growth.